So in this series, we've been looking at the 6 different ways that you can fund your business growth. Now, if you have short-term cash flow issues in your business related to operational cash flow or day-to-day cash flow, then you need different options of funding for when you're looking to grow your business on a long-term basis. So the options that you would look at are different because there's pros and cons between short-term and long-term finance. So the method that we'll have a deeper dive into today is equity investment, and that would be where you would sell some of your business or give away some of your business to an investor in exchange for a cash injection into your business. So we've all seen Dragon's Den, and the thing with Dragon's Den is when you watch it, these are all businesses that are asking for money, but they are not on Dragon's Den because they want money. They are on Dragon's Den because they want support and mentoring from the dragons, and they want access to their contacts, basically. So if you're in the situation where you just need a cash injection in your business, then I would say never ever consider an equity investor. The only time that you should consider an equity investor for funding your growth plan is if you also are perhaps lacking a skill, or you believe that having an additional person in your business will bring something such as mentoring or a contact or maybe access to something that you wouldn't get on your own. So if you do just need a cash injection in your business, do not consider equity investment. You might as well switch off now because it really just is not the route to go. Equity investment is for when you need to exit your business or when you're lacking something in your business, not just for cash flow purposes. But if you do want to consider an equity investor in your business, then you've kind of got 3 different types of equity investors in the UK. The most common are venture capitalists. These are the big corporate entities that normally have a fund manager. They will go and raise investment from individuals, typically high net worth individuals, and there will be a fund manager that will then decide where that money is invested. And typically venture capitalists are investing in businesses that haven't yet started, so they're pre-seed and they're just an idea, or are very, very new. So businesses, like Uber and Facebook and businesses like that, they've all been funded by venture capitalists. So normally venture capitalists are looking for these high growth, potentially massive corporate entities to invest in, not exclusively, but typically that is what venture capitalists are looking for. So they tend to not be suited for small businesses. Then the next option in the UK is private equity backed investors. And again, this can sometimes be an individual, but it tends to be a group of people. The significant difference from venture capitalists is that private equity firms tend to buy established businesses. They buy established businesses that have got historical proven profits, tend to be steady businesses as well, and they are normally looking to buy a controlling interest in the business and run it as a going concern. So generally that's what private equity firms are looking at. So if you're looking to exit your business, then a private equity investor could be the right thing for your business. But if you're just looking for cash flow and you want to stay in your business heavily involved and making the decisions, then a private equity investor is probably not the road to go down. Now, angel investors in the UK are by far the biggest source of equity investment into small businesses. And angel investors are typically business owners or entrepreneurs themselves, and they come with a wealth of knowledge and experience, and they will either buy a minority shareholding, so that's where you still retain control of the business, so you have more than 50%, or they may also buy a controlling interest or buy the entire business as well. So the beauty about using an angel investor is, as I say, they tend to be entrepreneurs and business owners themselves. So that means that they come with a wealth of experience and contacts. So if you're considering an equity investor, then getting somebody in your industry or linked somehow to your business and its supply chain will be really critical to the success of the relationship. And angels, you do get some angels that come in pairs or small groups with a lead angel. but typically they tend to be individuals, and most angel investors actually make a living from investing in businesses. That tends to be their business model, if you like. Now, with angel investors, because you're dealing with another small business owner and tend to be an individual, the arrangement that you have with them can be entirely bespoke. When you're dealing with sort of these bigger investment funds, they tend to be very specific in the negotiation and the contract terms, exactly what they're looking for, whereas angel investors, it tends to be much more flexible and probably much more small business orientated. So when you are discussing with an angel investor about investing in your business, obviously the main thing is that you want a cash injection up front. Some angel investors will be specifically looking for businesses in financial distress, or they will be looking for businesses where they can not put any cash in and instead will take an equity share in exchange for their advice. So you need to be very clear that the angel investor that you're seeking needs to have cash to invest in your business, because you don't want to waste any time talking to angel investors that are not the right fit for you. And when you're negotiating with them, I would always recommend in your business that you issue new shares rather than disposing of some of your existing shares. And what I mean by that is that when you first register a limited company in the UK, you have to issue a certain number of shares. And because of the way that the company registration process works, most companies are just simply registered with 100 ordinary shares of £1. And so when you are negotiating with an angel investor, you have the option of taking those 100 shares that you currently own, and you can give away some of those shares to them. So you can maybe give them 30 shares, or you could take those 100 shares and you could give more shares in your business and turn it into 150 shares, for example. So if you do sell your existing shares, then that is classed as a disposal from capital gains tax perspective. So you do need to consider that impact on your personal tax. And that's one of the reasons why issuing more shares is normally the recommended approach when you're discussing with angel investors. So once you have found an angel investor that's interested in your business, the price that they'll pay is largely dependent on the terms that are negotiated. So the three main things that you need to consider, and I can't stress how incredibly important it is to get legal advice on this, whilst from a financialist perspective, finance directors like myself will be able to talk to you about the tax implications and the financial implications and offer general advice to you on this. The long-term legal implications are where this could really fall down. So you definitely do need a lawyer to draw up the contracts on this for you. But you want to be talking about who has voting, control and dividend rights with their shares. So this is where you would utilise something called alphabet shares. And what that means is that you can have in your business structure, as I mentioned, when your business is normally created, there's 100 ordinary shares. And what we mean by that is every share is equal. So it has the same voting rights, it has the same control and it has the same dividends. But with alphabet shares, it allows you to say, okay, well, ordinary shares are class A, but we're going to have a different type of share, class B, which, for example, might not be allowed to vote on anything. So using alphabet shares allows you as the business owner to retain control in your business if you want it, and control what dividend payments are made to the angel investors and when, what control they've got in the day-to-day running of the business. Are they allowed to sign contracts? Are they allowed to vote in board meetings? Are they allowed to receive dividends every year? So all of these types of questions that you need to have clear in your mind as to exactly what you're prepared to offer an angel investor. Now, in reality, you can put whatever you want into the votes, into the shares class, So if you create an additional class of shares, you can say that this is a class of shares where they're entitled to dividends, but they've got no control and they can't vote on anything. But is an angel investor ever going to invest in your business on that basis? So that's then where you need to think practically about, actually, if you are trying to attract an angel investor in your business, you've got to offer them a fair deal. And this is where a lot of small business owners tend to fall down on this negotiation piece, because they want the cash, but they don't want to give up control. They don't want to give up a share of their future profits with dividend payments to the angel investor, and they want to restrict the voting rights too. Whereas from the angel investor's perspective, they're thinking, well, I'm investing in your business because you aren't able to raise the cash without me. So I'm incredibly valuable to your business and its future success. So I want a larger share of the dividends. I want more control over the business because I'm more capable than you. And therefore I want to be able to vote on more too. So you do need to be practical about what you are agreeing with your angel investor. And I have supported many businesses when they've been discussing with angel investors, and they tend to be quite easy to find an angel investor that is potentially interested in your business, but at the negotiation stage it always falls down. And actually, I'd say that probably for a typical business seeking an equity investor, I would probably speak to well over 100 investors to get just one offer on the business, and that's not even necessarily a price that the business owner would agree. So you can use a broker for this, but it's absolutely not necessary. A lot of this tends to be done through reputation and word of mouth with angel investors. There are some websites as well, where angel investors will register what they're looking for. So there are ways of sourcing angel investors without using a broker. But generally, I would say for a growth plan in your business where you just need cash, this is an incredibly complex process. It is incredibly time-sapping. And in terms of giving away your future profits, it just doesn't seem to make sense if the only thing in your business that you need is a cash injection.